After studying this module, you shall be able to learn about the characteristics and various functions of Indian capital market. Know about its constituents and types. Understand about various modes of raising funds in Indian capital market. Indeed, Indian financial services industry and capital markets today have come a long way from the days of floor-based trading of physical certificates, broker-run exchanges with questionable service standards and internal governance, non-existent derivative markets and government monopoly mutual fund markets. Changes have been rapid and visible. And today, India's capital markets can be compared with the most advanced ones elsewhere in certain respects, like the settlement speed, though certain parts like corporate bonds are yet to blossom. In this module, a picture of capital markets in India is being presented. Capital market in India is undergoing continuous significant changes to keep pace with the world financial environment and rapidly changing domestic economy. The capital market is an important component of the financial system. It is a market where long-term funds, both equity and debt, and funds are raised within and outside the country. The capital market helps in promoting economic growth by mobilizing the savings of various economic sectors and directing the same towards channels of productive use. Characteristics, features of capital market. 1. Securities market. Capital market deals in securities like shares, debentures, etc. Therefore, it is also called securities market. 2. Securities prices. The prices of securities that are dealt within the capital market is determined through the general laws of demand and supply. The equilibrium in demand and supply of securities brought about by the prices. The price depends upon number of factors like yield on securities, extent of funds available from public savings, level of demand for funds, price situation in journal, etc. The price mechanism prevalent in capital market ensures optimal allocation of scarce financial resources to the most productive sector of the economy. Third, participants. Capital market involves many players. The capital funds are either directly supplied by the financial intermediaries or arranged through financial intermediaries. The intermediaries form the edifice of a capital market. The participants in capital market include financial intermediaries like insurance companies, investment companies, pension funds, etc. Non-financial business enterprises and ultimate economic units like households and governments. Location. It is interesting to note that the capital market is not confined to a certain specific location. Although it is true that parts of the market are concentrated in certain well-known centers known as stock exchanges. It exists all over the economy wherever suppliers and users of capital get together and do business. 5. Demand and supply of funds. Demand for long-term funds arise from individuals, institutions, central government, state governments, local self-government and private corporate sector. Whereas the main sources of supply of long-term funds are individuals, household sectors, institutions, banks and industrial financial institutions. 6. Economic growth. Capital market plays an important role in the financial system. It promotes savings and investments, which are vital for the development and growth of an economy. It also accelerates the pace of economic development. Functions of capital market. Matten and Body, 1995, propose a six-fold classification of functions of capital market. Number 1. Clearing and settling payments. Financial systems provide mechanisms that facilitate the exchanges of goods and services, as well as assets, followed by settlement, transferring ownership in return for the agreed remuneration. Number 2, pooling resources and subdividing shares. Financial systems enable multiple investors to contribute to the projects that cannot be financed by one of them alone. Also, if a single investor could arrange money to fund a project, there may be certain incentives for diversification. Each investor contributes a small portion of project's total cost and bears a small portion of its risk. Number 3, transferring resources across time and space. A fundamental purpose of investing is to delay consumption. For example, as households accumulate wealth for retirement or for the benefit of future generations, firms in one industry or in one location may seek to invest surplus funds in another industries or at other locations. Financial system enables the assignment of funds from households and firms with surplus resources to others that seek to acquire resources for investment and future return. Number 4, managing risk. Financial systems provide several ways for investors to exchange and thereby to control the risk. For example, insurance helps in pooling of risk. Hedging helps in transferring the risk to speculators. Diversification exploits low correlations that may exist among risky projects. Number 5, providing information. Financial systems enable price discovery. That is, for those who wish to trade at the prices, it involves rate of exchange at which agreement can be made. Other information, for example, about expectations of future asset price volatility, can be inferred from market prices. Number 6, dealing with incentive problems. Financial system helps the individuals to construct the sorts of contracts that fulfill their needs and also helps them to cope with the contingencies that the contracts do not explicitly take into account. For instance, the shareholders of a firm may use debt to partly finance its operations. The contractual obligations for which are designed to provide incentives for the firm's manager to act in the interest of the shareholders. The functions of capital market can be divided in other way as well. Number 1, allocation function. It allows for channelizing of the savings of large number of investors into various productive avenues of investments. Number 2, liquidity function. It provides a platform which helps buyers and sellers to exchange the securities at mutually satisfactory prices without loss of time and value. Number 3, other functions. It includes indicative functions, savings and investment function, transfer function and merger function. Composition of capital market. Like Indian money market, Indian capital market is also composed of organized and unorganized sectors. The unorganized capital market includes indigenous bankers and money lenders, whereas the organized part includes non-banking institutions and special and development financial institutions. Capital market provides facilities and the institutional arrangement for borrowing and lending term funds that includes medium as well as long-term funds. Important point to note is that it does not deal in capital goods but helps in raising money for capital investment purposes. As already mentioned, demand for long-term capital arises from private sector, manufacturing industries and agriculture, and from government, largely for the purpose of economic development. For example, like central government and state government invest for economic overheads and also on basic industries that may include consumer good industries, so they need substantial amount from capital market, whereas supply of funds for capital comes largely from individual savers, corporate savings banks, insurance companies, specialized financing agencies, and the government. The institutions involved: 1. Commercial banks. Number 2. Life Insurance Corporation of India or LIC and General Insurance Corporation of India GIC. Special institutions like IFCI, ICICI, IDBI and UTI, etc. Number 4. Financial intermediaries like merchant bankers, mutual funds, leasing companies, etc. Types of capital market. Capital market can be classified into two parts. Number 1. Primary market. It refers to the long-term flow of funds from the surplus sector to the government and corporate sector through the process of primary issues, and to banks and non-bank financial intermediaries through the process known as secondary issues. Primary issues of the corporate sector lead to capital formation, creation of net fixed assets and incremental change in inventories. In simple words, this kind of capital market deals with the issue of fresh or new securities. Number 2 is secondary market. This market is concerned with outstanding securities. In other words, it deals with the existing claims. There is no new flow of funds for instruments in this market. That means there is no fresh capital is made available to the producers on account of the transactions in this market. But it facilitates liquidity and marketability of outstanding debt and equity instruments. The secondary market contributes to economic growth by channelizing funds into the most efficient channel through the process of disinvestment or reinvestment. It also provides instant valuation of securities, debt and equity both, made possible by changes in the internal environment. That is, through company-wide and industry-wide factors. This kind of capital market helps in reducing the cost of capital by providing liquidity, price discovery, and risk transfer capability. A secondary market is therefore that allows dealings between buyers and sellers of existing securities, which ultimately serves to enhance the liquidity of corporate stock. Parts of secondary market. The Indian market can be further divided into two broad parts. A. Market for corporates and financial intermediaries. That includes 1. Recognized stock exchanges. The activities of buying and selling of securities in a secondary market are carried out through the mechanism of stock exchanges. Stock exchanges form an integral part of secondary market in India. Number 2. Bombay Stock Exchange. Established in 1875, BSE, formerly known as Bombay Stock Exchange Limited, is Asia's first stock exchange. Over the past 140 years, BSE has facilitated the growth of Indian corporate sector by providing it an efficient capital raising platform. Popularly known as BSE, the board was established as Native Share and Stock Brokers Association in 1875. BSE provides an efficient and transparent market for trading in equity, debt instruments, derivatives, mutual funds. More than 5,500 companies are listed on BSE, making it world's #1 exchange in terms of listed members. The National Stock Exchange of India Limited, NSCI, it was established on November 27, 1992 under Companies Act 1956 to function as a model stock exchange. It aims at proving the advantage of nationwide electronic screen-based, scriptless and floorless trading system in securities. Number 4, Over-the-Counter Exchange of India, in short known as OTCI. There exists a ringless and automated stock market operating at the national level known as Over-the-Counter Exchange of India, which has been established to give a major fillip to the capital market. The exchange operates through a number of electronically linked counters at different locations, giving rise to a national trading system. It aims at helping small and startup companies to overcome the problems of raising capital through a public issue at exorbitant cost. It also helps investors to overcome the problem of illiquidity, inaccessibility, delayed settlement, and transfers that are abound with traditional stock exchanges. Number 5, the Interconnected Stock Exchange of India, in short known as ISE. It was established in 1998 in Vashi, Bombay, or Mumbai now as it is known. It is a national level stock exchange providing trading, clearing, settlement risk management and other support to its trading members. The participants are registered brokers including individuals as well as institutions. They operate through a network of sub-brokers and sub-dealers and are connected through an electronic networking system. B. Market for government securities and public sector undertaking bonds. The trading in government security is basically divided into short-term money market instruments such as treasury bills and long-term government bonds ranging in maturity from 5 to 20 years. The participants include primary dealers, banks, financial institutions and mutual funds. Constituents of capital market. Indian capital market is composed of 1. The gilt-edge market. Gilt-edge market is the market for government and semi-government. It is also known as government securities market. The securities traded in this market are stable in value and are much sought after by banks since banks are obliged under the Banking Regulation Act to maintain a proportion of total deposits in government securities. The feature of gilt-edge markets are return on investment is guaranteed. There is no speculation in securities. Institutions base investors who can, as per law, invest a portion of their funds in these securities. Last, negotiation of each transaction due to large volume of transactions. Number 2, industrial securities market. Industrial market offers an ideal market for corporate securities such as bonds and equities. Industrial securities market is of two types. One is primary market, second is secondary market. Modes of raising funds in primary capital market. The various modes of raising funds can be majorly divided into following ways. One is public issue. When an issue or offer of shares or securities is made to new investors for becoming part of shareholders' family of issuer, it is called a public issue. It can be further divided into two parts. A. Initial public offer. According to SEBI, means Securities Exchange Board of India, when an unlisted firm makes either a fresh issue of shares or convertible securities or offers its existing shares or convertible securities for sale or both for the first time to the public, it is called an IPO. B. Further or follow-up public offer. As per SEBI guidelines, when an already listed company makes either fresh issue of shares or convertible securities to the public or an offer for sale to the public, it is called FPO. Number 2, right issue. When an issue of shares or convertible securities is offered to the existing shareholders as on a particular date, record date in short, fixed by the issuer, it is called a right issue. The rights that are offered to the shareholders are evaluated on the basis of number of shares or convertible securities held as on the record date. Number 3, private placement. When an issuer makes an issue of shares or convertible securities to a selected group of persons, it is called as private placement. Private placement of securities or convertible securities by listed company can be done in 3 ways. Number 1, preferential allotment. When a listed issuer issues shares or convertible securities to a selected group of persons in terms of provisions of Chapter 7 of SEBI Regulations 2009, it is called preferential allotment. Number two, qualified institutional placements. In short, it is known as QIP. When a listed issuer issues equity shares or non-convertible debt instruments along with warrants and convertible securities other than warrants to qualified institutions buyers. Number three is institutional placement program. When a listed issuer makes a further public offer of equity shares or offer of sale of shares by promoter group of listed issuer in which the offer, allocation and allotment of such shares is made only to qualified institutional buyers. Globalization of Indian capital market and participation of foreign capital. Globalization of the market simply means integration of home market or national market with the overseas or international markets. It allows from both sides to interact with each other and play their part in both the markets as they wish and as they are allowed to. It facilitates international movement of the capital funds, enabling it to find the best productive outlet and utilization, at least theoretically, with the minimum of frictions posed by market imperfections. International market for long-term financial claims constantly exchange between the market players spread across the borders or nations. Globalization of Indian capital market comes from various routes. Some important routes are foreign direct investment, known in short as FDI, foreign private investment and foreign institutional investors, in short known as FIIs. FDI refers to the investment in enterprises located in one country but effectively controlled by residents of another country. There are private foreign investment by way of minority participation in equity capital of the companies in India. The policy relating to participation of foreign capital was first announced in 1949 after the announcement of the first industrial policy. It was operative when the next industrial policy was announced in 1956. The objective of foreign investment policy in India was based on advantage to the countries. It was recognized that Indian capital needs stock market supported by foreign capital, not only because national savings will not be adequate to promote the rapid development of the country on the whole, but also because in many cases scientific, technological and industrial knowledge and capital requirement can be secured along with the financial capital. This policy broadly stated that the government would accept foreign capital under certain conditions, namely 1. All undertakings, Indian or foreign, most conform to the general requirement of the government's industrial policy. Number 2. As a rule, the major intent, ownership and effective control of an understanding should remain in Indian hands. The process of globalization of finance has assumed greater significance and power than that of production, especially in recent years. The volume and mobility of global finance capital has surprised many observers. In 1986, about 188 billion passed through the hands of money changers. With the introduction of liberalized policies in 1991, India has witnessed a significant surge in private capital flow. Prior to 1991, capital flows consisted largely of foreign direct investments, official flows, commercial borrowings and non-resident Indians deposits. Since capital markets were closed to foreign investors and only entry available was through a country fund, a limited amount of foreign portfolio investment were routed through a small number of offshore fund called the India Fund in 1986, which was listed in London Stock Exchange. With the government's policy shift from official borrowing to foreign investment, measures were taken to attract foreign investment in the form of both FDI and portfolio investments. In February 1992, the government announced that Indian firms should also raise funds through equity and convertible bonds issued in euro markets. In September 92, the government allowed the portfolio investment in Indian capital market by permitting foreign institutional investors to access capital market in registration with the Security Exchange Board of India. Till January 1998, 481 FIs were registered with SEBI. Summary. Let's consolidate what we have discussed so far. Capital market may be defined as a market for borrowing and lending long-term capital funds required by business enterprises. It represents all the facilities and institutional arrangements for borrowing medium-term and long-term funds. Like any financial market, capital market is also composed of those who demand funds, that is borrowers, and those who supply funds, known as lenders. Capital market is of two types: primary market, secondary market. The various modes of raising funds by companies are public issue, right issue, and private placement.